a story as old as greed itself, a promise of easy money, a charismatic figure spinning dreams of guaranteed returns, and countless victims left holding the bag. This is the Ponzi scheme, a scam that has ruined lives and made headlines for over a century. From Charles Ponzi, the man who gave the scheme its name, to Bernie Madoff, the architect of the largest Ponzi scheme in history, these cons preyed on trust and ambition, leaving financial devastation in their wake. But how do these schemes work? Why do so many people fall for them? And what can we learn to protect ourselves from the next great con? Today, we uncover the Ponzi scheme playbook. A Ponzi scheme is one of the simplest and most effective financial frauds ever conceived. Its genius lies in its ability to create the illusion of wealth and success, all while hiding a crumbling foundation. Every Ponzi scheme begins with a promise. The promoter claims to have discovered a foolproof way to generate consistent, high returns, guaranteed. Whether it's a revolutionary investment strategy, a secret market opportunity, or cutting-edge technology, the details vary, but the message is always the same. This is your chance to get in on something big. In the beginning, the scheme appears legitimate. Early investors are paid their promised returns on time, often exceeding their expectations. These payouts don't come from profits. They come from the money contributed by newer investors. This creates an illusion of success that attracts even more participants. Trust is the lifeblood of a Ponzi scheme. Early investors, impressed by their apparent profits, often become the scheme's biggest promoters, convincing friends, family, and colleagues to invest. This word-of-mouth marketing spreads like wildfire, bringing in the steady flow of cash the scheme needs to survive. The con artist cultivates this trust through charisma, exclusivity, and a carefully curated image of success. Lavish lifestyles, glowing testimonials, and even media coverage all serve to reinforce the illusion of credibility. As more people invest, the scheme grows exponentially. With new money constantly flowing in, the con artist can keep paying returns to earlier participants, further enhancing the illusion of success. But this growth comes at a cost. It requires an ever-expanding base of new investors. This is the fatal flaw of every Ponzi scheme. Eventually, the pool of new investors dries up, or too many people try to withdraw their money at once. When that happens, the scheme collapses, leaving victims with nothing but empty promises. While Ponzi schemes vary in their details, most share common warning signs. Promises of high returns with little or no risk. Consistent profits, even during market downturns. Lack of transparency about how the money is invested. Pressure to reinvest instead of withdrawing profits. Victims often overlook these red flags because of the emotional appeal of the scheme. The fear of missing out, combined with the lure of quick, easy profits, can cloud even the most rational judgment. The collapse of a Ponzi scheme is inevitable. When new investments slow down, the con artist can no longer pay returns. Investors start asking questions, and as panic spreads, the entire scheme unravels. By the time a Ponzi scheme collapses, the damage is already done. Early participants may escape with profits, but most investors are left with devastating losses. The average victim is left wondering how they fell for the con in the first place. So why do Ponzi schemes work so well? Part of their success lies in human psychology. People are naturally drawn to the promise of wealth and security, especially when the opportunity seems exclusive. Social proof, seeing others invest and profit, further reinforces the illusion. Even when doubts arise, many victims convince themselves to stay. The fear of losing out on future profits or admitting they made a mistake keeps them invested long after the cracks begin to show. The simplicity of a Ponzi scheme is its greatest strength. It preys on trust, ambition, and hope, leaving behind financial ruin when the lies inevitably catch up to the con artist. Understanding how these schemes work is the first step to protecting yourself from becoming their next victim. Every con has its mastermind, and for the scheme that would later bear his name, that mastermind was Charles Ponzi, a charismatic Italian immigrant with a knack for reinvention. Ponzi's rise to infamy was as audacious as it was destructive. Born in 1882 in Lugo, Italy, Carlo Pietro Giovanni Guglielmo Tebaldo Ponzi dreamed of wealth and success far beyond what his modest upbringing could offer. In 1903, he immigrated to the United States, hoping to make his fortune in the land of opportunity. Like many immigrants, Ponzi struggled to find his footing. He bounced from job to job, always chasing the promise of a better life, but never quite achieving it. By 1919, he was living in Boston and desperate for a breakthrough. That breakthrough came in the form of an obscure financial instrument, the International Postal Reply Coupon. These coupons allowed someone in one country to prepay for a reply to their letter from another country, avoiding the hassle of exchanging currency. Ponzi claimed he had discovered a way to exploit differences in currency values to turn a profit. He could buy coupons cheaply in countries with weaker currencies and redeem them for higher values in stronger economies. On paper, it seemed brilliant. Ponzi told potential investors that he could generate a 50% return in just 45 days and double their money in 90. It was an offer too good to refuse, and soon money started pouring in. In early 1920, Ponzi's operation exploded. Word of his miraculous returns spread like wildfire, and within months, he was handling investments from thousands of people. At its peak, Ponzi was raking in over $250,000 a day, an astronomical sum for the time. With his new fortune, Ponzi lived lavishly, embodying the image of success that kept investors coming back for more. But behind the scenes, his operation was little more than smoke and mirrors. The first cracks in Ponzi's empire appeared when skeptical journalists and regulators began scrutinizing his business. They found no evidence that Ponzi was actually buying or redeeming postal reply coupons on the scale he claimed. Despite growing doubts, Ponzi managed to maintain his facade by paying early investors with money from newer ones, creating the illusion that his system worked. But as more people demanded their returns, the pressure mounted. In July 1920, a critical report revealed that Ponzi's liabilities far exceeded his assets. Investigators discovered that for every dollar he owed to investors, he had less than 30 cents on hand. The scheme was collapsing. In August 1920, Ponzi's empire crumbled. Panic spread as investors realized they had been duped, and the once admired businessman became the target of public outrage. Within days, his office was shut down, and he was arrested for fraud. Ponzi was sentenced to 5 years in federal prison, but his troubles didn't end there. After serving his time, he faced additional charges at the state level, ensuring that his fall from grace was complete. Although Ponzi spent the rest of his life in obscurity, his name lived on as the symbol of financial fraud. His scheme became the blueprint for countless cons, proving that greed and trust could be weaponized to devastating effect. Charles Ponzi's story serves as a timeless reminder of the dangers of blind ambition and unchecked greed. While his scheme may have collapsed a century ago, the playbook he created continues to ensnare victims to this day. Over the decades, Ponzi schemes evolved, adapting to new industries, technologies, and economic climates. Though the core mechanics remain the same, the methods and victims have changed dramatically. In the mid-20th century, Ponzi schemes found fertile ground in real estate. Promoters claimed to offer guaranteed returns on property investments, promising profits from rents, developments, or sales. But behind the scenes, there were no properties, just a steady flow of new investor money propping up the illusion. One of the most infamous cases was orchestrated by Equity Funding Corporation of America in the 1960s and 70s. The company faked insurance policies and financial documents to inflate its value, deceiving investors into believing in its success. When the scheme collapsed, it caused massive financial damage and shattered trust in the insurance industry. By the 1980s, Ponzi schemes began targeting affinity groups, communities bound by shared faith, culture, or social connections. Promoters exploited these close-knit networks, using trust and familiarity to recruit victims. Religious groups were especially vulnerable. Leaders and members were persuaded to invest because the con artist was seen as one of their own. This exploitation of trust made the schemes particularly devastating, both financially and emotionally. One example was the scam orchestrated by Barry Madoff, a teenage entrepreneur who ran ZZZZ Best, a fake carpet cleaning company. His scheme targeted local churches and small businesses, leaving many in financial ruin. The Internet revolutionized Ponzi schemes. By the late 1990s and early 2000s, con artists began using online platforms to reach a global audience. These schemes, often disguised as high-yield investment programs, promised astronomical returns within weeks or even days. One infamous example was the scheme run by AdSurf Daily, which claimed to pay users for viewing online ads. In reality, the program used money from new members to pay earlier ones. When it collapsed in 2008, thousands of victims were left with nothing. In recent years, cryptocurrency has become the latest frontier for Ponzi schemes. The allure of digital assets, combined with their complexity and lack of regulation, makes them an attractive vehicle for fraudsters. One such scheme was BitConnect, which promised users guaranteed returns through a proprietary trading algorithm. Investors were encouraged to reinvest their earnings, creating a cycle that enriched the scammers while keeping victims in the dark. When BitConnect collapsed in 2018, it wiped out over $2 billion in investor funds, leaving countless individuals financially devastated. The case highlighted the need for greater vigilance and regulation in the fast-moving world of crypto. So, why do Ponzi schemes keep working, even after countless warnings? The answer lies in human nature. Greed, trust, and the fear of missing out are universal vulnerabilities that scammers know how to exploit. Social proof, the idea that if others are doing it, it must be safe, is a powerful motivator. Combined with promises of exclusivity and guaranteed returns, it becomes almost irresistible. The collapse of a Ponzi scheme doesn't just hurt its direct victims. The ripple effects can destabilize entire industries, erode trust in legitimate businesses, and strain communities. From Charles Ponzi's first con to modern crypto scams, the playbook remains the same. Only the details have changed. Understanding how these schemes evolve is the first step in protecting ourselves from their destructive power. At the apex of Ponzi schemes stands Bernie Madoff, the man who orchestrated the largest financial fraud in history. Over the course of decades, Madoff manipulated the trust of thousands of investors, amassing a fraudulent empire worth an estimated $65 billion. But how did he do it? Bernard Lawrence Madoff began his career in the 1960s, founding a small brokerage firm with a modest $5,000 loan. His initial success came from embracing new technology, using computer systems to streamline trades. Madoff's firm became a respected name on Wall Street, laying the foundation for his reputation as a financial pioneer. Over the years, Madoff cultivated an image of reliability and expertise. His firm was one of the first to adopt electronic trading, earning him a position of influence and eventually the chairmanship of NASDAQ in the early 1990s. While Madoff's brokerage business was legitimate, his investment fund operated in the shadows. It promised steady, market-beating returns, 10 to 12% annually, regardless of economic conditions. For his clients, it seemed too good to pass up. Madoff's Ponzi scheme relied on a simple yet devastatingly effective system. He took money from new investors and used it to pay returns to existing clients, creating the illusion of consistent profitability. Unlike most schemes, Madoff's operated on exclusivity and trust, avoiding flashy marketing or high-pressure tactics. Madoff's approach was sophisticated. He claimed to use a strategy called split-strike conversion, involving options trading to hedge against losses. But in reality, no trades were taking place. The detailed account statements sent to clients were entirely fabricated. Madoff's victims came from all walks of life. Some were billionaires and elite institutions, drawn to the exclusivity of his fund. Others were middle-class retirees and charities, entrusting him with their futures. Many were referred by friends or family, adding another layer of trust to the scheme. For many, Madoff wasn't just an investment manager. He was a trusted confidant. This trust made the eventual betrayal even more devastating, leaving victims not only financially ruined but emotionally shattered. The global financial crisis of 2008 triggered the collapse of Madoff's empire. As markets crashed, investors scrambled to withdraw their funds. For decades, Madoff had managed to keep up appearances, but the sheer volume of withdrawal requests exposed the truth. There was no money. Madoff confessed the scheme to his two sons, who worked at the firm. They reported him to federal authorities, leading to his arrest on December 11, 2008. The man, who had been a symbol of trust and success, was now the architect of financial devastation. In 2009, Madoff pleaded guilty to 11 federal felonies, including securities fraud, wire fraud, and money laundering. He was sentenced to 150 years in prison, the maximum allowed. It was a clear message. No one, no matter how powerful, is above the law. Madoff's scheme succeeded for so long because of his impeccable reputation and the exclusivity of his fund. By targeting elite clients and maintaining a sense of scarcity, he created an air of legitimacy that discouraged skepticism. Additionally, regulatory agencies failed to act on early warnings. Several whistleblowers, including financial analyst Harry Markopoulos, raised concerns about Madoff's operations years before his arrest, but these red flags were ignored. Bernie Madoff's name will forever be synonymous with greed and betrayal. His scheme was unprecedented in scale, but its lessons are universal, an enduring warning about the dangers of unchecked ambition and blind trust. To protect yourself, always ask questions, demand documentation, and consult independent advisors before investing. If something sounds too good to be true, it probably is. Thank you for watching Cash Chronicles. If you found this story valuable, hit the like button, subscribe, and join us next time as we uncover the fascinating stories behind the world's biggest financial scandals.